It fell more than 9% in a single session, the kind of one-day move people associate with once-in-a-generation moments, not with the so-called safe haven. They told investors this kind of move couldn't happen in gold, and it didn't stop there. In the next stretch of trading, the slide continued until prices were printing below $4,500 an ounce. Not months, not weeks. In about 48 hours, the market went from confidence to confusion. Silver was even more brutal. 96. It's structure breaking. And here's the part most people don't notice while they stare at the red candles. Big institutions tend to know the stress points before the public sees them because they live inside the plumbing. They see the leverage, the margin, the liquidity, the inventory constraints, and the rules that can change overnight. So when the screen explodes, the real story is rarely the headline explanation. The real story is what happened behind closed doors, in risk committees, exchange notices, and margin models that decide who gets time and who gets forced. What I'm about to walk through is not rumor, and it's not a conspiracy story. It's a pattern. It's a mechanical sequence that has repeated across decades, across different metals, and across different crises. Welcome to Atlas Ledger, where we decode what matters before it becomes headlines. This channel isn't built on hot takes. It's built on market mechanics, institutional behavior, and the patterns that repeat when the cast of characters changes. If you appreciate calm analysis in a noisy world, consider subscribing the way you'd keep listening to a wise elder in a crowded room. And tell me where you're watching from, because the gold story looks different in every currency. Now let's reconstruct the event with forensic detail. The move didn't begin with a single headline. It began with positioning that was already stretched. Gold had run hard, and that run invited leverage. Futures markets make leverage easy. You can control a large notional amount with a relatively small margin deposit, and as long as price moves in your favor, leverage feels like brilliance. But leverage has a hidden truth. When the market turns, it doesn't ask if you're right in the long term. It asks if you can pay today. Going into the late January window, traders were leaning into the idea that gold could keep climbing as uncertainty stayed elevated and as official buyers continued to accumulate. Central banks, for example, were still adding. One monthly snapshot showed 53 tons of net buying in October 2025, a jump of roughly a third from the month before. That matters because it tells you the long horizon bid was not a myth. But a long horizon bid does not prevent a short horizon liquidation. Then the catalyst arrived. A sharp repricing of rates and the US dollar in response to shifting expectations about policy. Gold is not just a metal. In modern markets, it trades like a referendum on real yields, on liquidity, and on the credibility of paper promises. When yields surge and the dollar strengthens, gold often gets hit, not because its long story disappears, but because the discount rate changes and leveraged positions become fragile. As prices started to slide, the first wave of selling looked normal. A pullback, profit-taking, a reset. But the second wave was not a choice. It was a requirement. To understand why, you have to understand margins. On a futures exchange, margin is the good faith deposit required to hold a contract. It is not a down payment on gold bars. It is a risk buffer. Exchanges adjust margin to reflect volatility. When volatility rises, margins often rise. The logic is simple. If price can move farther in a day, the exchange needs more cushion to ensure that losing traders can pay. But the effect is brutal. Raising margins during stress forces traders to post more cash immediately, or reduce positions immediately, or get liquidated. In this episode, the margin story had a second layer. In mid-January, the exchange governing these contracts changed its margin-setting methodology for precious metals, shifting toward requirements based on a percentage of contract value. That sounds technical, but it matters because it ties margin more directly to price level. When price is high, percentage-based margin can rise faster, and when volatility spikes, the increase can feel like a trapdoor opening under leverage. Now place that rule change into late January, when price starts falling fast. A falling price reduces collateral value for some participants, while rising volatility increases required margin for all participants. It's the worst combination for leveraged longs. And if the exchange then announces margin increases again into the drop, as it did by the end of the month, the pressure turns into a cascading force. This is the mechanism that can turn a correction into a shock. Look at a key footprint: open interest. Open interest is the number of outstanding contracts. If price falls and open interest rises, that can mean new shorts are pressing the move. If price falls and open interest collapses, that often means liquidation, the forced exit of existing positions. In the latest weekly data around this episode, COMEX gold futures open interest fell from 528,004 to 488,463. That's nearly 40,000 contracts disappearing. That is not a calm repositioning. That is an evacuation. And evacuations don't happen politely. They happen at market, into thin liquidity, because the constraint is time. A margin call is not an essay prompt. It's a deadline. So the crisis unveiled looks like this. A price that was elevated meets a policy expectation shock. Volatility rises, margins tighten, and leverage becomes a liability. The market slides, then breaks. Gold drops more than 9% in a single session, a move reminiscent of the early 1980s, 7% to the high 70s. Now the question becomes, why did it feel coordinated, as if the market was pushed through a narrow doorway? Because margin and liquidity changes happen in centralized places, and those changes ripple through every participant at once. An exchange notice is not public theater. It's operational reality. Risk managers don't debate it on television. They enforce it on terminals. This brings us to the hidden pattern. When this happened before, the story always sounded different on the surface, but the playbook was similar underneath. In 1980, the silver market experienced a legendary squeeze and then a legendary collapse. The narrative involved a concentrated attempt to corner supply, but the mechanism that ended it was the same type of lever: rule changes and margin hikes. When margins rise, leverage dies. When leverage dies, price can fall faster than fundamentals can explain. In 1983, gold experienced a sharp downside episode that still gets referenced because it broke the psychological contract investors thought they had with the metal. The lesson wasn't that gold can't act as a hedge. The lesson was that gold can still be a leveraged trading instrument in the short run, and leverage can overwhelm narrative. In 2008, gold first sold off during the scramble for cash, even as the long-term case for monetary hedges strengthened. That always surprises people until they realize that in a liquidity crisis, the first asset that moves is the one you can sell quickly. The most liquid markets become the source of cash, regardless of the story. Moment. But the structure again pointed to concentrated selling in paper markets, stop-loss cascades, and the interaction of ETFs, futures, and risk limits. The long-term arguments didn't vanish in a weekend. The short-term structure did. And now, in early 2026, you see the same pattern again. A narrative that seemed solid meets a structural break that forces selling. And the speed of the move tells you it wasn't a slow change of mind. It was a forced change of balance sheets. That's the historical pattern. The timing does. Now let's talk about the players, because behind closed doors is not a vague phrase. It means specific institutions making specific decisions that mechanically influence price. First is the exchange complex, CME Group and its COMEX division for metals. This is where futures contracts trade, where initial and maintenance margins are set, and where risk models update. When CME changes how it calculates margin, it changes the leverage available to every participant, from hedge funds to proprietary trading desks to commercial hedgers. A methodology shift effective January 13, 2026, tied precious metals margins more explicitly to contract value. Then, after the plunge at the end of the month, margin requirements were raised again, reinforcing deleveraging pressure exactly when the market was most fragile. Second are the clearing members and bullion banks. These are institutions that intermediate the futures market, provide liquidity, and manage large books across spot, futures, options, and forwards. Their risk managers are paid to survive, not to be right. When volatility explodes, they reduce exposure, widen spreads, demand more collateral, and cut credit lines. None of that requires malice, it requires math. Third are leveraged funds. Some are macro funds expressing views on inflation, growth, and policy. Some are commodity trading advisors following trend signals. Some are relative value shops arbitraging spreads. They are all sensitive to margin. When margin rises, they either bring in cash or reduce position size. In a fast move, reduction wins because cash takes time. Fourth are the real economy hedgers: miners, refiners, industrial users, and jewelers. They hedge prices to stabilize operations. They are not usually the driver of a 48-hour cliff, but their hedging flows can matter at the margin, especially if the price move triggers hedging programs or supply decisions. Fifth are the official sector buyers and large long-term allocators. Central banks, sovereign funds, and some institutions view gold as a reserve asset or a strategic hedge. Their behavior is slow and often underreported in real time. The fact that central banks were buying tens of tons in late 2025 doesn't stop a liquidation event in January 2026, but it matters for what happens after the forced selling exhausts itself. Now add the timing. The market breaks. Open interest collapses, indicating liquidation. The exchange tightens margin. The clearing members tighten credit. Leveraged funds meet their deadlines. This is where it gets interesting because the biggest confusion in moments like this comes from dislocation. A dislocation is when two signals that should align don't. You can see it in the open interest decline, and you can feel it in the intraday gaps and the urgency of selling. Another market, however, was still quietly expressing strategic demand. Central bank accumulation didn't disappear. The long-term thesis that gold hedges monetary disorder didn't suddenly become invalid in 48 hours. Yet the price acted as if the world had changed permanently. That mismatch is the dislocation, the difference between short-term forced flows and long-term structural demand. There's another dislocation that often appears in precious metals, paper versus physical. Futures and unallocated markets can represent huge notional amounts relative to readily deliverable inventory. Most participants don't want delivery, they want exposure. That's fine in calm times, but when trust is stressed, the spread between paper price and physical availability can widen. Not always in a way the public sees. Premiums can rise even as the headline price falls because the headline is being driven by leveraged paper selling, while real-world buyers are searching for metal that actually settles. When those two markets diverge, it creates a paradox. The screen says cheaper, but the store says scarce. The paradox doesn't last forever. Either paper selling finishes and price rebounds toward physical demand, or physical demand retreats and premiums collapse. The longer the gap persists, the more pressure builds for repricing somewhere. The dislocation can also show up geographically. Demand patterns differ between East and West, between futures-dominated centers and regions where physical buying is cultural and persistent. During stress, those differences can magnify. The point is that the market is not one market. It is many markets stitched together by arbitrage, and arbitrage weakens when credit tightens. So what's the evidence that this was a structural event, not just a mood swing? Start with the price moves themselves. A more than 9% one-day drop in gold is not normal behavior for a deep global market unless leverage is being forced to unwind. A 27% one-day drop in silver is a neon sign that something broke, because silver is volatile but not casually record volatile. Then look at open interest. Nearly 40,000 gold contracts vanishing in a week is the signature of liquidation. Liquidation means positions being closed, often at any price, to meet margin. It is the opposite of patient selling. Now look at rule changes. A shift in margin methodology, effective mid-January, followed by margin increases after the plunge, creates a feedback loop. Higher margin reduces leverage, which forces selling, which can increase volatility, which justifies higher margin. That loop is not theoretical. It is how crashes accelerate. There was also a quieter contradiction playing out in analyst notes and institutional research. On the same week that screens were flashing historic downside, several large banks and research desks were still framing gold as a strategic asset in a world of sticky deficits and fragile confidence. That contradiction confuses people because it sounds like someone must be lying, but both can be true at the same time. The long-term thesis can remain intact while the short-term structure is forced to unwind. Behind the scenes, the language inside firms shifts quickly during episodes like this. Traders talk about levels and flows. Risk managers talk about stress tests, liquidity ladders, and intraday collateral. Treasurers talk about cash. The market's tone changes even if the headlines stay calm. This is why institutional movement often looks invisible until you learn where to look. It shows up in the basis between spot and futures. It shows up in the bid-ask spread, widening at the moment liquidity is most needed. It shows up in the option surface, where implied volatility jumps and skew tilts toward protection. It shows up in the way correlations snap, pulling gold into the same risk bucket as everything else for a few sessions. And it shows up in timing. Margin notices often land after the close, when the public is offline and the professionals are still at their desks. All right. Funds that cannot meet calls become sellers in the next session. That selling becomes the explanation commentators cite after the fact. By the time the story reaches social media, the mechanical damage has already been done quietly. And look at the macro tape. When rates and the dollar are repriced abruptly, metals can fall even if the longer inflation narrative remains. The market is revaluing the cost of holding a non-yielding asset and the opportunity cost of capital. That is why gold can sell off during a liquidity squeeze and then recover later when the policy response changes. Now let's make the mechanism simple with an analogy. Imagine a crowded theater with a narrow exit. Everyone is comfortable because the movie is good. That's leverage in a rising market. Then someone smells smoke. That's the first price drop. A few people stand up and walk out. That's profit taking. But then the alarm blares. That's volatility. And then the staff closes half the doors and says, the remaining door is now the only exit. That's a margin hike. Now it's not about comfort. It's about capacity. People who would have stayed are forced to move, and the movement itself creates more chaos. Margin is the door narrowing. Open interest falling is people leaving the theater. The record moves are the stampede. Once you see it, you realize the most important behind closed doors decisions were not about gold's value. They were about the market's leverage. Now, what does this mean going forward? Historically, events like this resolve in phases. Phase 1 is liquidation. This is where price overshoots because forced sellers don't negotiate. Phase 2 is stabilization. Volatility drops, margin requirements stop rising, the selling becomes two-sided rather than one way. This is often when headlines declare the move over, even though it's just paused. Phase 3 is repricing based on who remains. If the liquidation flushed out weak hands and left structural buyers still active, price can recover faster than people expect. If the liquidation reveals deeper demand weakness, price can grind lower and stay there. There are a few scenarios that follow from the data without making a prediction. In a conservative scenario, volatility cools, margins normalize, and the market finds a new clearing, level where leverage is lower. In that world, gold might trade more like a steady macro asset again, responding to yields, the dollar, and risk sentiment rather than to forced flows. In a moderate scenario, the dislocation between paper selling and structural demand resolves through a rebound once the forced selling ends. That rebound would not be magic. It would be the absence of mechanical pressure. In an aggressive scenario, the stress spreads. If margin tightening and credit tightening coincide with broader risk deleveraging, correlations rise, and multiple markets sell together. In that case, gold can be pulled around by liquidity needs in the short term, even if its long-term role strengthens. That's what 2008 taught. So what should be watched? Not acted on, but watched. Watch open interest. If open interest stabilizes and then rises while price stabilizes, it can suggest new positioning rather than continuing liquidation. If open interest keeps falling, it can mean the unwind is still underway. Watch margin announcements. When exchanges stop raising margins, the feedback loop weakens. When they raise margins again, the loop tightens. Watch real yields and the dollar. Gold's short-term sensitivity to these can dominate during episodes where the market is trading policy expectations. Watch physical premiums and delivery behavior. When physical tightness appears while paper price is weak, it's often a sign that the headline price is being set by forced flows rather than by true supply-demand equilibrium. Now we come to the choice ahead, and it's not a choice about what to buy or sell. It's a choice about how to interpret shocks. Most people see a violent move and assume it proves a story was wrong. But the data often shows something else entirely. The story may have been intact while the structure snapped. Those who understand this world don't obsess over the last candle. They study the plumbing, they watch how leverage is priced, how rules change, how margins shift, and how open interest reveals whether a move is a battle or a rout. This is not about being smarter. It's about paying attention to the right layer of reality. Because the information gap becomes the wealth gap. Institutions move first because they must. Risk committees don't wait for headlines. They respond to models, to margin notices, to credit limits. Retail often moves last because retail hears the story after the mechanics have already done their work. And that is why the phrase behind closed doors matters. The doors are where the rules live. The rules decide who gets time and who gets forced. If this episode did anything, it reminded the world that gold is not only a symbol, it is also a market with leverage, with liquidity constraints, and with institutions whose job is to protect the system, even when the protection feels like a shock. This is Atlas Ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the question isn't whether markets will surprise. The question is whether you'll recognize the pattern when the surprise is really just the mechanism repeating. In markets, mechanics matter more than mood every time.